Bubbles bursting. Double, double, toil and trouble. Love the bubbles, love the bursting. Two contrarian Halloween takes for you to consider. Bubbles are good, and bubbles bursting are also good. So what's the scariest stock market thing this Halloween? To have read the popular financial press over the past 10 months is to absorb over and over again the idea that maybe we are in an artificial intelligence market bubble. Round about the cauldron go, in the poisoned entrails throw, toad that under cold stone days and nights has 31, sweltered venom, sleeping got, boil thou first in the charmed pot, double, double, toil and trouble, fire burn, and cauldron bubble. So like the basic observation and worry explained in a good Wall Street Journal article this week on circularity in an AI investing is that US companies, one, established a giant lead in AI technology 2 to 3 years ago. Two, some of these US companies, such as NVIDIA as chip maker, AMD as chip maker, OpenAI as LLM innovator, Google as catch-up competitor, Microsoft as early large OpenAI investor, Oracle as computing power beneficiary, all of these companies are invested in one another and inking high dollar deals with one another, which tend to have the effect of inflating both company revenues and market valuations. Number three, extraordinarily large capital expenditures are happening all over the country and world to build out the data centers and computing power to match future AI demand. And four, investors have gone totally gaga for AI leaders, pushing NVIDIA to a recent high of $5 trillion valuation, Apple to a $4 trillion valuation, Microsoft to close to $4 trillion. The magnificent 7 tech companies that make up the top of the S&P 500 are up collectively around 700% over the last 10 years. So the big market fear is that we are observing an AI bubble. So here's where I say, it's definitely a bubble, but bubbles are okay, actually. I mean, of course, I don't know if it's a bubble. The bubble implies an unwarranted and unsustainable high valuation for companies and markets. I have nearly zero insight into the AI market in the correct price for AI public and private companies. So how could I say for sure? I would instead say that this opportunity for investors to jump into an authentically innovative and disruptive technology will attract US and global capital until it is a bubble. I don't know when it stops, but it won't stop until it's a bubble, and then beyond. The most natural thing in the world to happen here is an overshooting of the mark. It's going to grow and grow and grow until a lot of goofy investments, goofy mostly only in retrospect, get made. Technology investing is a very imprecise art, which must go wrong much of the time. The direction of the technology may be clear, AI is big and real, but the literal correct valuation for a company involved in the rollout of AI is anything but clear. You may as well put on a pointy hat and wave your hands around in a spooky reenactment of Shakespeare's Three Witches for all the fundamental precision you can apply to AI business valuation. Just throw in the toad and entrails and venom over 30 days, and round the cauldron go. Let the valuations double and double, toil and trouble, and then let it bubble and pop. So here's the historical tech investment analogy, the internet revolution, obviously. The IPO of Netscape in 1995 kicked off a race to back internet browsers with, for the time, unlimited capital. The internet and internet browsers and all that followed were the AI of the late 1990s. It expanded and expanded and expanded until, of course, lots of parts of it became a bubble. Yahoo and AOL and all manner of what today we consider tech dinosaurs got blended and mixed and chanted over and inundated with capital, but now are essentially fossilized relics. And all sorts of results from this stew are possible. For example, Mark Cuban became a billionaire because he built broadcast.com and then sold it to Yahoo for $5.9 billion in stock before his site became defunct. Cisco Systems is and was an important provider of hardware and software to the technology sector and business sectors. It was briefly worth $500 billion in 2000 and was the world's most valuable company. It lost 89% of its market value between 2000 and 2002. It's still a valuable company at around half its peak today. But any theoretical buy and hold investor in Cisco during the 2000 bubble has yet to recover her initial investment 25 years later. Intel shares dropped 84% peak to trough 2000 to 2002 and has yet to reach its peak 2000 price. Palm was a cool company, so was Lycos. Even Pets.com had its charms, Eye of Newt and all. Despite all this bubble bursting and wasted capital, the internet revolution within the real economy continued just fine. Just because the NASDAQ cratered for years didn't mean that the technology or its massive shakeup of the economy took any meaningful step backward. Investors in the builders of the world's fiber optic future had particularly volatile ups and downs in the era from 1997 to 2002. Global Crossing, a computer networking services company, went bankrupt in 2002 after peaking at a $47 billion valuation. The company 360 Networks had a brief $13 billion market capitalization before going bankrupt months later. WorldCom had a fraudulent accounting problem before that led to its demise and takeover by MCI. But despite all this bubble bursting and, frankly, wasted capital, the world got overbuilt fiber optic infrastructure, which arguably set the stage for the next generation technology takeover with video services like YouTube and Netflix. We don't know which AI companies are the future AOLs and Yahoo and Pets.com, but we're going to damn well fund a bunch of them until many of them burst. That's okay. The excess will go away. Some stocks can go down 50% or 89% or even 100%, but the AI transformation in the real economy will not disappear. So my next contrarian take, down markets are good, actually. So the bursting of the bubble is also an important part of the process. The magic of stock investing doesn't work unless the whole thing blows up every once in a while. The only reason you can make good money as a long-term investor is because periodically short-term investing and similarly unwise activities like investing with leverage or investing with options or day trading has to transform its practitioners from the prince into the frog. I don't mean to be callous about investors' losses. It will feel bad when things are down 30% from here. I promise I will be unhappy too, as I have money in the stock market. I will not literally be happy with a significant drop in my household's net worth. But here's the main thing. If stock markets always went up every year by a steady, let's say 10% each year, and never went down once in a while by, let's say, 5% or 25%, then there could be no risk premium for investing in stocks. Risk premium, just to be a little definitional, simply means you get rewarded for being a stock investor by some unpredictable but real superior return over time when compared to riskless investments like bonds and CDs and annuities, because stocks are risky. It's the occasional loss that keeps the risk premium out there to be captured by those with sufficient patience. When given a choice between a steady, let's say 4% annual return on bonds and a steady, never fail 10% annual return on stocks, obviously, every single rational investor would choose the steady, never fail 10% return. And investors would rationally make that choice every day, all day long, until the stock market only returned, on average, 4% per year. That is to say, the return on a non-risky stock market would quickly return something equal to bonds. If it never goes down, people will buy it until its return is the same as a non-risky asset, since the never going down feature makes it, by definition, another non-risky asset. The fact that you periodically lose your metaphorical shirt investing in stocks is what discourages people with a short time horizon or a propensity to gamble or an addiction to leverage from buying stocks. The fact that not every available dollar is invested in stocks is what allows long-term investors to gain the risk premium, when they hold for the very long term. A long-term investor in the S&P 500 index since October 1995, which is roughly my investing lifetime, has enjoyed a 9.9% annual return, also known as a 17x return over 30 years. But you don't get the 9.9% annual return as a long-term investor unless you also endured the gut-wrenching downturns of 2000, 2008, plus frankly scary as hell losses in years like 2018, 2020, and 2022. You've got to make it periodically scary enough for short-term investors to keep them out in order to leave the long-term risk premium for long-term investors. So, the market could easily burst and correct and drop in valuation by 30%. And it's also worth noting that 30% down from today's level on the S&P 500 last occurred in January 2024. And it wasn't a stock market hellscape 20 months ago. It was fine. It was frothy even. So, concluding Halloween thoughts. The AI bubble worry overall is about as scary as a miniature Pennywise on your doorstep this evening begging for Twix bars. It's predictable. It's baked in. It's bound to happen. It is in the nature of the thing. Some investors in some companies will get their asses handed to them. Meanwhile, the real economy, built on real advances in technology, will chug forward, probably slowly being transformed by AI, just as we were by the computing revolution in the 90s, the internet revolution of the 2000s, the mobile phone revolution of the 2010s. If it's your first Halloween ever, sure, be freaked out, sell, sell, sell. But if you've been around here for a while, you should kind of expect the jump scare. Broad equity markets could very easily be down 25% in a month from now, and you should not be shocked. Specific tech darlings, maybe one or more of the Magnificent Seven, or maybe a few lesser well-known names, could be down 50% or more by the end of the year, and you should not be shocked. It should, in fact, feel normal. What do you do about it? Well, one of the few actionable things to know is that the largest 7 U.S. companies make up about 37% of the S&P 500. 10 years ago, they were just 12% of the S&P 500. So, it feels prudent to maybe diversify a bit if your entire nest egg is 1/3 exposed to just 7 companies. Other than that, if you've got a time horizon above 5 years, just treat the bubble and the bubble bursting like the spooky jump scare it is and the necessary precondition for providing a good return on holding volatile stocks over the long run. Happy Halloween.